So without any further ado, I will hand things off to you, David.
Thank you so much. Really appreciate everything you do, Jackson. So thank you. Um, hey everybody, pretty excited to be here with y'all. Um, got a couple slides today I'd like to share, but we're going to be doing some other cool, new, interesting things, and I think they're exciting. So let me get a few things open here and make sure we're all queued up. And then I want to share some things with you guys. So again, we'll do a couple slides. I know you guys like those kind of general ones, and then we'll dive into do some sort of live demos of our tools that we offer, InfoSparks, which of course is through North Star RMLS. But a couple other things that I would really like to show you guys that I think you're going to get a kick out of. So with that, as we say, let's get my share going. Good enough for me. Okay, guys. Um, yeah, so you guys, you might have read this. You might have seen this one. I'll just read it for us. In 1971, the interest rate for a mortgage was about 7.33%. If you waited for interest rates to go down, you wouldn't have purchased a home until 1993. 22 years, you would have been stuck in your home just because of the interest rate, and you would have been waiting for them to go down. Meanwhile, the value of that home likely tripled or quadrupled. So, long story short, don't wait to buy real estate and wait. You guys have, I'm sure, all heard the quote, marry the house, but date the rate. You know what? Because this is pretty informal, you guys, I want to show you. You talk about dating the rate. Let's just hop over. Oh, well, you know what? This may not totally, actually, yeah, it does reflect it because this is usually weekly. Yeah, frequency weekly. And so I wasn't sure if it would capture that latest move down. Sure enough, guys, look at this. We've seen some nice movement. We are so close to 6.9. I think if we see 699 or 695, um, I think people are going to kind of come out of the woodwork. That's what I think. So if you sort of check it out here, you'll see when we hit almost 8, and then we were kind of down and then up a little bit, and now we've taken the second leg down, which is encouraging. Another way to look at this, I like Mortgage News Daily. I like to go historic rates, and then, hey, look at that, guys. Wow. Would you look at that? So look at where we were not that long ago. 7.5. I think we were even 7.6 for a while. And now we're starting to see 7.5, 7.4, 3, 2, 1, 7 flat. So we're moving in the right direction. And that's encouraging. So we're moving in the right direction. That's a good thing. We've seen that, a couple different ways. So keep watching for that. Let's see. You know what, guys? I think I want to switch this one more time. This is not working for me. Bear with me, 30 seconds here. Let's stop that and let's get this guy over here. And let's move this here. Here we go. All right, and now we're going to share this one. Okay, this will be better for us. Screen 2, there we go. That's our one. Okay. And now let's move this guy over and make sure this guy gets big. And that's probably still not the way I wanted that to go, is it? There we go. That's what I want. Okay. Okay, so let's keep chugging, guys. Yeah, we got a quick agenda, guys. We're gonna skip through some of this. We're not gonna cover everything, so just know that we're gonna do a little bit of skipping here. I've brought in a couple new ones lately as we think about where we are in the cycle, business cycle, economic cycle, rate cycle, the market cycle, what have you. So I wanted to bring this one back in. I think I had this one last time, but it's useful to think about this, kind of in this way. Of course, that's not what I wanted here either, is it? Well, this'll do for now. And so you have this expansionary period, and you get into oversupply, then recession kind of right sizes things, and then we're in recovery, back to expansion, back to oversupply. So you guys can see some of the traits or hallmarks that accompany these different market cycles. So oversupply, you start to level off or increase more slowly. In recession, now you have usually adjustments down, and then recovery, some of that excess oversupply space is being absorbed. So you guys kind of understand that. Another way to think about it, not quite in a loop, but when you get out of this part of the buyer's market, you usually kind of go back in. So you guys can see how that looks: recovery, expansion, hyper supply, oversupply, and then recession. So first two are sellers markets, where sellers are in control. As you get oversupply, the buyers are in control. Now the buyers have all the power. So pretty interesting there. You know what? We're not going to do that one. I think you guys have seen that one plenty. Let's do showings though, and let's make sure we do the most recent. Oh, you know what? We have done, I have done some additional work to this, and I do want to show you guys. So take a gander at this one. This is where we look at change in showings in blue and and interest rates in gray. So as we've talked about, as you saw rates start to ease, you saw showings start to rise. No surprise, that's exactly what we expected. I've kind of drawn two little lines here that hopefully are helpful in terms of simplifying sort of a noisy data set. Let's actually take out the noise now. Interesting. Now I've just got the trends. What is this telling us? Rates kind of down, showings down less, right? Look, rates higher as rates start to ease in blue, showings start to come up. Sorry, as rates ease in gray, showings start to come up in blue. Inversely related here, guys. And then look, as rates kind of trickled up to that 7.5 mark, you started to see showings kind of turn down again. So it's exactly what you would have expected. This is kind of a duh factor, but it's nice to visualize it and kind of show it in this way. So that was beginning of April, where we saw a 35% increase in overall showings. And then this is the beginning of May, where we actually saw a 12% decrease in showings compared to the same period the year prior. So, that was a change, and we know that that has to do with the rate situation, with the rate environment. Yeah, so we've got April data. Is this our first? Yeah, of course. We only do this webinar once a month. This is our first time showing April numbers. We've been looking at Feb and then March and now April. That's how calendars work. Okay, so the change in new listings, the biggest gains are coming in the luxury, right? In the big stuff. So especially as you get over, as you get over 350 and especially over 500, that's where you start to see the gains, most of the gains. Pending sales, I guess, interestingly, I guess you do have a little bit of increase here. There's just not that much product there. If you have 100 of them and the next year you have 110, that's a 10% increase, but it's not really that much. You really, again, start to see the gains in demand on that side of the price spectrum. Sure enough, especially as you get over 1 million, right? Especially. Yeah, buyers and sellers, we'll do a couple of these because I know you guys haven't seen April, so let's just cover a few of these. Another encouraging sign, right? This was another encouraging data point that is consistent with, I guess I'll say, turnaround, right? Some recovery after the Fed-induced blows from the higher rate environment. So that's encouraging. You guys can kind of see how that looks. It's not like we've surged up to, these levels, or God, not those levels, but it's nice to see that we're no longer falling and we're sort of off the floor. 6,300, pretty tied up with, remember April of 2020, right? COVID lockdowns, what was it, March 16th, March 15th of 2020? That fateful day where we worked our tails off to make sure you guys were considered essential workers, and really proud of that accomplishment, actually. And so nice to see a 20% bump there up to about 6,300. I'll ask the question again, are they ready to jump in the water? It looks like sellers are thinking about it. Enough are starting to that I think I'm ready to call it a pattern that new listings are and have been on the rise. So we've done that one. So let's stop there. Let's skip that one. Oh, this is actually kind of an interesting one. Hope I don't say that about all my slides, as sometimes we joke. How many sales did we lose because of the rate lock-in effect, right? That's pretty interesting. Well, here it's about 25,000, right? Our Wisconsin friends to the east, about the same, more like 26K. Of course, bigger states, California, Texas, Florida, New York, Pennsylvania, Illinois, you'll see a lot more. Washington, you'll see more. So this is from the rate lock-in effect. I'm not going to list my home. I would have been a move-up buyer ordinarily, would have sold my 350 home in South Minneapolis or Richfield or Bloomington and rolled 150K in equity into a 550 home in Lakeville or whatever, right? Sometimes you've got downsizing boomers or upsizing millennials or what have you. So a lot of that activity has been lost as people have felt locked in, locked into their interest rates, locked into their homes. Lawrence Yun likes to use this one. I've sourced this from him. What happens over 2 years? A lot happens. Why don't you take a look? That's lots of things: babies, marriages, unmarriages, deaths, as much as we hate to talk about it, right? Retirements, as much as we look forward to it, new jobs, job switches, so on and so forth. So pending sales up 8%, not quite as robust of a gain as that 20% gain you saw for seller activity. So buyer activity up, nice to see that, only about 8%, but 4,300 at least lifts us off the floor, right? This 39.94 was pretty much bottom of the barrel over the last, 21, 22 years even. So nice to see this. We got room to go, room to grow, I should say. Not here magically overnight. Also not here magically overnight. It's going to take some time to grind back. But if you guys have seen us talk about the great mean reversion, we've got a chart on that. It's like stocks, guys. Overall stocks do that, but any month or quarter, they might kind of fluctuate. And so be thinking about that long-term versus short-term. Long-term macro growth, short-term sort of micro fluctuations along the path. Why do people move? The 5 Ds: diamonds, diapers, degrees, divorce, and death. Some might say that's the ideal order, but you guys do you. Whatever makes sense in with your lives and everything works for us. So maybe diapers come before diamonds, or who knows? Diamonds, diapers, degrees, divorce, and death. I always kind of like that one. All right, couple more here before we shift gears a bit. Let's see. I know I'm skipping around, guys. You've seen most of these. I do have a couple new ones. So how about inventory by price range? Here's your under 200K versus over 500,000 in dark blue here. 08, 09, 2010, the market was on sale. Fire sale, you might even say. A lot of foreclosures and shorts, so REOs and short sales selling for 50, 60, 75 cents on the dollar. That means if it would have been a $300,000 home and it's in foreclosure, right, it would have sold for two and a quarter, something like that. So a lot of what would have been 300, or I should say, a lot of what would have been $250,000 sales actually were 180, 175, and 190. So you see this surge in under 200K activity. Wow, has that gone away? For the most part, it's really disappeared. And then look how interesting that is. Let me zoom in a little bit. How interesting that we just crossed the 300 to 500K has actually fallen below 500. What that means is there are more active listings over 500,000 than there are active listings between 3 and 500,000. Interesting. Interesting. I don't know that I would have expected that, because our median is what, about 375, 380. So that means the bulk of our activity in that bell curve, the bulk is kind of right in the middle. But that's where the price point is. That isn't necessarily where all the supply is. That's where I guess you could say that's where the demand is. It's not necessarily where all the supply is. And as we can see, not only is the supply moving up there, but as we also saw, hate to go back over old material, but as we also saw, look at the change in pendings, that's where you see the demand as well. So, new listings, that's where you see the supply coming on, right? Kind of, move up market. 250, I still think of as 250 as a first-time buyer segment, right? But as you get over 350 into the 400s and surely into the fives, I think you're talking more of the move up market. As you get into 750, I would argue you're starting to get into the luxury segment. Someone called it, someone from our board a few years ago called it entry-level luxury or affordable luxury. Maybe those are 650s or sevens. It depends on the area. Wayzata is not Roseville. And so pretty interesting to see the kind of comparison. All right, skipping back. So we did that one. And then absorption rates, right? We're all the way up to 2 months of supply, which is actually below 2020 and the two pre-COVID years. But I think this is where a lot of the magic kind of happens. And you know what? I wish I had labeled these. Maybe I can do that now. There you go. I'll label them for you. You guys are seeing the magic happen live. You like that? I guess I'll leave the other one. You guys get the idea, though, with 2.3 months of supply, 1.25, and then this one in the middle, of course, with 1.4 months. So I know that was a little bit geeky. Different ranges here, you guys, little bit different ranges. So I kind of left out under one, the sub 150, the truly affordable. Sometimes some of that is in distress or they're really small, 500 square foot condos. It wouldn't be any land because we're only looking at single family condo townhome. So it wouldn't be land. But, obviously people are always surprised. I can, look on Northstar now, look at solds in the last 30 days under 100K. There are always several. So no matter what segment, even 500 to 750 still has only 2.3 months of supply. Yes, that is almost double the 1.2 months of supply that we see in 2 to 300. So that's another interesting thing. There's actually slightly better supply in 150 to 200 than there is 2 to 3. Why? Because I shouldn't say you have issues. The quality difference between 150 and over 2, usually if you're single family with over 1,500 square feet, there has to be something kind of going on for you to be, 150 or below. Typically you'll see, a little bit better situations in the 250, 275 range. I think that's why absorption rates are tighter in that range and a little bit looser in this range. Maybe that's more of an investor segment, even though investors aren't a huge share. They have been a growing share of the market, but by no means are they a huge share. So a couple interesting things to think about there. Yeah, we always like to cover this one. So April price breaking out by single family, condo, and townhome. 4.25 single family, about 220 condo, about 312, 315 if you'll be generous for townhomes. Yeah, let's see, monthly versus rolling 12. Well, what I wanted to show here was, well, this is just April. I kind of like zooming out a little bit and looking at the broader picture. So over the last 12 months, look at sales, under 200 down. Even 200 to 300 also down. Why? Those folks are pretty rate sensitive. They all need a loan. And with mortgages where they were throughout surely the end of April, you can understand how the demand just wasn't there. So we saw a decline in demand. As you get 300 to 400, you start to flatten out a lot flatter. As you get over 400 and as we saw over 500 and especially over 1 million, now you start to see some gains. Not huge gains, but gains, and everything else was down. New construction, what's going on? I think we did show this one last time. Sometimes it's nice to bring it in. And actually, you know what? I updated it. So every month I do update this. So this is 2024 year to date. This is not a full year. So be careful with this. But what I'll say is, well, caveat, Do builders enter all their listings in North Star? God, I wish they did, but they don't. So when I say 15% of the market's new construction, it's probably more like 16, 17. What we say is I'm 100% confident in the trend, 100% confident in the trend, only about 90, 94% confident in the level or the figure. Does that make sense? So there's a difference. So, when we're saying 15, the truth is probably more like 16 and a half or 17. When we're saying, 6, the truth is probably more like 6.5 or 7. So just know that we're underreporting a little bit, but the trend is the same. The trend is intact. And I argue that's more important than the level. So what's going on? Jackson and I have talked about this, and I think we had a blog or two about it last year. Well, new construction is kind of existing is pulling back. Why? Because we're locked to our interest rates. We're locked in. Builders aren't locked. Builders are incentivized to sell and move their product. So new homes are actually a growing share of what was a shrinking pie. Now the pie is kind of growing again, but that's just happened in the last few months. And it's nice to see some new construction. Why is inventory so low, guys? I don't know. I can't figure it out. Let's take a look at new private housing units authorized by building permits. Let's take a look in 05 when we had, is this in millions? Thousands? Wait, maybe just units. So 1,600 building permits. This is monthly, right? So look, we came down. This is the Great Recession, 08, 09. Look at us come down. Guys, we have had population growth since here. Compared to here, our population is up here, but our building activity is still down here. We've been underproducing housing, underbuilding new housing, going on 20 years. 20 years, 05 to 25. 2 decades of underbuilding. And then we kind of, scratch our heads and wonder, well, how come we have no inventory? Where did it all go? Well, this is why. And even this, you guys, even this is a little too high level. Let's get it a little more granular. So sure, there's first time buyer segment, there's luxury and everything in between. What generation is having 10,000 retirements a day, every day? It's not millennials or Xers or Gen Z. It's boomers. What are boomers looking to do? Well, they're downsizing. Kids are well grown, well out of the house. And so they're looking at selling the single family home. They were supposed to be able to sell it for 500,000. And then they were supposed to buy a townhome for 325 or 300. They were supposed to have that $200,000 difference, and they were supposed to buy an RV. They were supposed to buy a condo in Florida or Arizona or some other place like that, and have time and money to travel and see the grandkids. Now they're selling the single family home for 500 and they're spending 475 on the townhome or 450. That's not the way it was supposed to go. That's assuming if they can find that townhome, which we also haven't been building. We haven't been producing single level townhomes that make sense for boomers with aging backs and aging knees, and who don't want to do snow and lawn care. And we just haven't been developing that product. So shame on us. We've got nobody to blame but ourselves. And what did someone used to say? When you point the finger at someone, you've got 3 pointed back at you, something like that. Anyway, what was going on here? I always like calling this stuff out just because it's interesting to me and I'm weird. COVID 2020, look at the COVID shock, builders. And then they said, wait a minute, there's a buying frenzy. Let's build homes. And then the Fed came in and poured cold water on all that. And now they're starting to lift up again. I'd like to see us here. I don't know that we quite need to be here, but I would like to see us a little closer to here. I guess you could argue we do need to be here given absorption rates and inventory and population growth. So I guess I'm ready to say that. Jackson and I, we'd want to do some math on, inventory, absorption rates, balanced markets, and really look at that. I don't know that I can commit to this number, but I can tell you for sure we need to be higher than we are. Yeah, and we've shared this over the months here. Housing supply is structural, housing demand is cyclical. I'll just riff on that for 20 seconds. Guys, housing supply, you want to build homes, Lennar, someone wants to build homes. You got to buy the land. You got to have the capital, raise the capital, investor capital, bank lending. You got to have the capital to buy the land. You got to do the acquisition. You got to do the entitlements. Then you got to get materials out to the site. Then you got to do, road and utility and infrastructure and stormwater development. Then you got to have labor and materials to build the homes. Then you got to market them and have agents and market them and sell them. Housing supply is structural. I didn't even mention get the building permits, right? Did I mention that? You got to get the building permits. Housing supply is structural. It is influenced by and influences so many structural elements of the economy. Housing demand, a little more whimsical, a lot more cyclical. Honey, I know we were thinking about buying, but I just don't like where rates are. So let's just put it on hold for a few months or maybe until next year. Yeah, sounds good. That sounds good to me. Housing demand, cyclical, much more whimsical. A builder can't really say, I've got half the homes built in this new development in Farmington. Yeah, let's just pull the plug on the rest. I guess some of that was happening in 09, actually on a couple downtown projects. I remember I worked for the city at that time. I think there was a lot on Washington by Bridgewater that now could it be AC Hotel or that parking ramp? And it was a big empty thing and it was excavated out and we called it the pit. It was the pit. Something like 2 or 3 developers tried to do something with it in the tough times after the recession and it just never really got off the ground. Okay, so we talked rates. Let's talk payments for just a second, guys, and then we'll get into some more detail around that. Time check 2:30, about halfway through. I think we're okay. You guys are smart folks. I think we had a couple new people join. You guys are smart folks. I looked at some of your names. I know some of you. I know you're smart folks. You guys have seen this. You know how to read this. Just in case anyone needs a refresher. This is payment. Your payment is in the table. Your loan is at the top and your rate is off to the side. I read this at an angle. It's as simple as that. I want to keep my payment at $2,500 a month. That's what I'm comfortable with, $2,500. So if I want to keep it at 2,500, 25, 25, 25, 25, well, guess what? At 5.5% for that 2,500 a month payment, I can borrow 440,000. If I want to keep that same 2,500 a month payment, but now rates are 7.5%, well, yikes, I can borrow 80 grand less, only 360,000 to have that same 2,500 a month payment. So that's kind of useful. Another way to think about this, there's a lot going on here. Another way to think about this is let's have the price in the middle. So here's your payment off to the left side. Here's your interest rate at the bottom. And here's kind of how much home you can afford. So again, if I want to be at, let's call it 2,000 a month. A lot of folks are more comfortable with that. Let's call it 2K a month. Well, wow, when rates were 3%, I could buy a $600,000 house. Now that rates are 7%, if I still want that 2,000, payment, well, like we saw, now I'm more like 375. So you guys kind of get that. Yeah, we've done this one. I wish it were better news. This one, we actually do have monthly numbers on this. I think I'll bring the monthly back in. This is annual and only goes through 2023. You guys know payments are up 1,600 to 2,700, 1,100 a month, 13 grand a year-ish, whatever that is. So not the best news there. Let's do something else interesting. You guys are going to like this one. This is kind of a payment workbook, or excuse me, it's really an income needed workbook. So you guys can kind of see exactly what's needed. So I think you'll like this. Let me just pull it up quick. I've got that link. By the way, guys, shoot us an email and I'm happy to share this with you. I think you'll like it. I think you'll see why. Okay. We're doing things live today, guys. We're keeping things informal. Yes, yes, I get it. All right. So we've got some assumptions. Mortgage rate, tax rate, insurance rate, down payment, max percent of income that the payment can be. So I only want my payment to be 30% of my income. And then what's our price appreciation assumption? at 7% interest with 10% down to afford a home in Afton without spending more than 30% of my income, my family or my household would need to earn about 225 a year. Or each wage earner, assuming there's two wage earners, each adult wage earner would need to be making about what, 112, 115. Now, to live in the Armitage neighborhood at 7% interest, at 10% down with 30%, your household only needs to be making 120K a year. That's two wage earners each making 60. Well, that's a lot more reasonable and actually is pretty darn close to our sort of median, family income. So you guys can kind of scroll down, anywhere you want. We got the Brainerd MSA even, the Brooklands. We should have Bloomington in here somewhere. So what else should we do? Let's do Andover. Well, used to be more affordable. Now it's 425. Albertville is a 350. So, that's a lot more reasonable. Watch this. Home price appreciation. Let's assume 5% appreciation. This all changed. Now, maybe we'll have 2.5. Okay, so a little bit better. If we go back to 0, that's basically just saying that's current year with no price appreciation. Let's say I got a buyer, but they really only want to spend 25% of their income. Well, now they need to make more for that payment to occupy a lower share of their monthly budget. A little geeky, a little wonky, but if you guys kind of stick with it and get it, I think it's powerful. And by the way, I would say let's do our view and maybe freeze our panes up here so that we can kind of have our options here and we can see, right? We can still see. So, Columbia Heights, a slightly more affordable area where homes are just under 300K. Look, you can be making 86K. That can be a single wage earner. There are still some parts of town where a sort of typical single wage earner can afford a home. It's not the case in all states or all regions, but there are still a few places here that allow you to do that. Dayton's Bluff, cool neighborhood in St. Paul, right? Typical homes are 250. That's 1,900 a month. Someone can be making about 75K a year and not spend more than 30% of their pre-tax income. Now, let's say you can get to 20% down. Notice income needed dropped. And now, what are we? Well, rates are, what we just had 7, so 6.99 is not going to be that big of a difference. But let's say we hit 5.9. Now to live in Afton, you need two wage earners each making what, 90, 95, right? But then when we were 7.5, and let's say we could only do, 5% down, and let's say we might wait till next year when we have 4% price appreciation. Well, now each wage earner needs to make 125 to get to 250. You guys with me on that? Let's see. I got a couple chats here. Steve is saying it was on internet that US-wide the first 4 months of 24 said 19% of buyers were investors. I believe that's national. So forgive me, I missed that. That was 10 minutes ago. I believe that's a national stat. Steve, I'm glad you mentioned it. Let's do this because this is live and informal. Guys, this is kind of what I love. I like all of our, I love teaching CE, but because this isn't for CE, it gives us the freedom to do stuff like this. I want to give a shout out to our good friends and colleagues that we truly admire over at the Minneapolis Fed. Jackson and I have known Libby for a long time, and she's great, and just so are all of their people there. So, Steve, long story longer, it depends on what we call an investor. Is it someone who owns two properties? Well, what about mom and pop owners, investors who own a duplex? I'd like to be one of those one day. I don't. I only own my own home. Or are you talking like a Haven Brook, some of the BlackRock, or what's the other one? Shoot. Oh, actually, here, it'll be here. Home Partners, Invitation Homes. There you go. Yeah, so properties owned. And if we set the cutoff to 100 or more, you guys can kind of see how that looks. let's just talk about the elephant in the room. There's a geographical element to this, and unfortunately, there's a racial element to where you see very high levels of investor ownership. That's the north side, folks. That's North Minneapolis right there. That's downtown. This is Dinkytown as you kind of get into Dinkytown Stadium Village. A lot of investors because student housing. As you get out to Linden Hills, Lake Harriet, Bede-Makaska, you don't see as many investors, do you? The price points there just don't make sense for a return on investment. So there you have it. To answer Steve's question, the share of residential properties that are investor owned. If we define this by 100 properties, it's only about 2%. But that goes up if we want to count everybody who owns 2 or more. Now it's, what is it, about 3.3. So, when we hear things like what percent of home buyers are investors, a lot of this is going to be national. The answer is no, not even close. All right, housing. I like Housing Wire. Housing Wire gets it right. Investors bought 26% of the country's of the most affordable. So of the low priced, whether they define that as sub 200, sub 300, or in California, 600,000 is very affordable. March investors accounted for 27%. Core Logic, that seems high to me, but remember that's national. So Florida, guys, retirees moving to Florida, a lot of those folks have at least $500,000 cash, if not, well over. Having $1 million for retirement now just isn't what it used to be, as hard as that is to say. So careful what you read, Steve. I know you're good about that stuff, and you get it, and I know you consume a balanced media diet, but just be careful. Make sure to read the fine print. Is it of all price points? Is it just condos? Is it only the Sun Belt? Is it national? Does it include duplexes? This kind of stuff. So just be careful with that. Let me say this though. I suppose now is an opportunity. I think it's hard for first-time buyers to compete. It is, because it's hard for first-time buyers to compete with cash, because sellers look at the cash and say, this is a sure thing. Even though, their hearts might be in the same place. So you're absolutely right. You're absolutely right. God, Yvonne, brilliant. I don't know about brilliant, but I'm glad you like it. I'm really glad you like it. That's awesome. Okay. Oh, you know what? One more thing, as long as we're bouncing around, because this was raised, and look at this. There you go. Year to date 24, cash sales. Ooh, interesting one. A lot of cash here because homes were on sale and people could afford to pay cash. Not a lot of cash in the bubble. Now, cash sales, cash sales, or the share of cash has gone down. What was going on here? Why that 10%? 2020. Everybody and their mother wanted to buy a home and rates were 2.8 or 3%. I didn't need to use cash. Let your cash earn 5, 10, 20% in the market and borrow at 3 or 4. Let your cash work for you. Don't take 300 grand, out of the S&P. I'm not a financial advisor. This is not financial advice. But a lot of people think that taking 300 grand out of the stock market and foregoing 10% returns when you could borrow at 4%, that doesn't make a lot of sense to me. But some people they have this allergy to debt where I'm just allergic. I don't want a mortgage. That's fine, but your capital probably isn't going to be growing like it could have been. So just something to think about. Not a financial advisor. That is not financial advice. 18% done in cash. So to the investor question, a lot of investors deploy capital in the form of cash, but not all, right? Folks who do have some liquid capital who don't want to pay 7% interest and are willing to part with some of that cash, maybe it does make sense. By the way, it's possible the market's down 10% this year. It's sure been up so far, but it's possible the market's down 10% this year. So if you're using your cash and not letting your cash decline by 10%, and you're using your cash to save paying 7% interest, that makes sense. right? That makes sense. But the market could be up 15% this year, and then borrowing at 7% actually sounds like a good idea when your 300K could earn you, 8, 10, 12% in the market. So pretty interesting. I bet you wish you had it all in Nvidia. Is that back up to 1,000 a share yet? Anyway, that's been an interesting one to watch. Let's see, what else? Do we want to shift gears? I think we're ready to shift gears. And I think we waited too long to shift gears even, because I have about 10 minutes left. Wow, how the time flies, my friends. All right, so let's go into our world here. Let's go to mplsrealtor.com. Very simple, our homepage. Couple ways to think about it. I like to go in this today in the market section. You might prefer to click market data. When I click today in the market, it brings me to our Fast Stats portal. I'll close it because I already had it open here. Fast Stats. Let's just start with the monthly report, guys. Very handy way to see what's your engine temp, what's your vehicle speed, what's your RPMs, so you can see new listings, the level, and the change. This is for April. This is year to date so far. So pretty well matched up, 19 and 21, pretty well matched up. Pendings, closings, market times, sales price. Sales price is up about 4% for April, but actually more like 5% so far year to date. Sellers getting, wow, 99.9% of their original list price that they received at the time of sale at the closing table, or maybe in the purchase agreement, I guess. That's actually down a little bit from last April, which was, believe it or not, over 100, even though rates were high last April. 2 months of supply, not enough. New listings, the last 3 Aprils compared to the last 3 year-to-date periods. And then we've got, what do you see here, guys? Seasonality. We are a seasonal market. We are a beautiful winter market. At least we used to be winter market. We used to have winters. It seems like this year we skipped winter. My kids were riding bikes outside in January. That's a pretty rare thing. So you guys see the historical numbers going all the way back to 04. Same with pendings, April, year to date, historic back to only 05 in that case, so on and so forth. Let's kill that. Let's go back to Fast Stats. This is where the magic's going to happen, guys, the local market updates. Sometimes I like to joke, Jackson's very tired of hearing this joke. Sometimes I like to say these are like the old Russian dolls, remember? The nesting dolls. Why didn't I like them? Because they were so full of themselves. Oof. So anyway, I'll click on Hennepin County, then we get Minneapolis. I'll click Minneapolis, and then we see, let's do the Nokomis community. Then we see, Erickson, Northrop, Field, Hale, Minnehaha neighborhoods. Let's click on Morris Park neighborhood. Boom, about 305, which is about 275 per foot. Wow, because prices in this area are a little bit more affordable than the metro, sellers are getting darn good offers. They're getting full price offers plus 2%, 102%. Wow, something must have been happening. But look, guys, that was only from one sale. So I don't know if it had some condition issues or a locational issue or water things or something that the seller accepted about 92.5% of asking price, or they took off 7.5% of their list price. Interesting. Wow. Half a month of supply, 6/10 of a month of supply. What is that? 2 weeks? So what would that be? 16 days of supply, a little over 0.5. So a little over 2 weeks of supply. That's pretty insane still. So, guys, if you're going to look at, if you're going to go to the monthly indicators and try to counsel a buyer or seller about whether it's a good time to buy or sell in an area, well, you're going to feel a little bit let down. And actually, they probably will too. Why? Because this is high level. This is for the whole Twin Cities region. The beautiful part about the local market updates is just like we saw. Wayzata has a median sales price of, I'm guessing, 1.1. I'd be wrong, 1.3, 900. Oh, 1050, that's pretty close to 1.1, 1050. So yes, 1.3 million and change, and they're still getting 99.3%, but they're actually a balanced market with 5.5 months of supply. Really interesting data points here. And so that's why Zeta versus Morris Park, that was, of course, very different. So if you guys just use the monthly indicators, know that you're looking at the change in closed sales and you're combining Roseville, Richfield, Edina, Wayzata, Egan, you're combining everything. So it's useful to say that sales in the metro are on the rise again. I think that's useful. It's useful to say that market times, rose a lot when rates were up, but they're slowly starting to come down where homes are selling faster, not much faster, but market times are no longer rising. They're starting to fall slightly. These are good tools. This is good language. Prices overall up 2% metro wide, but in your neck of the woods, they might be up 70% or down 10%, right? This is why we absolutely encourage you guys to utilize the LMUs, the local market updates, when you're counseling buyers and sellers. What did someone say? Actually, I think it was Jackie Berry at orientation just the other day. She said, start wide and zero in. So listing presentation or a call, whatever. She'll start with the monthly indicators. Spend 5 minutes. This is what's happening in this region, in this market. Then go to the LMUs. This is what's happening in your neighborhood or your city, what have you. And then she starts to go into the CMA, into the more granular. So kind of market, neighborhood, listing, right? So I kind of like the way she funneled that in. And I've heard people do something similar, but it was a useful way for me to kind of think about that. All right, so you guys understand the difference between the monthlies, the weeklies are just that, a weekly report, and the locals, and you kind of get, when and why to use which. Let me close a few. Let's shift gears. As you will know, within Matrix, well, I should say within North Star, you will see InfoSparks. You will know InfoSparks is the most powerful residential market analysis platform you'll ever know, at least as far as we know. This was built in-house here when we had our subsidiary that has since been sold to Showing Time and then off to Zillow. And so this is the most powerful way to look at market stats, most powerful and rich tool for market analytics. Twin Cities region. Why is it so powerful? Not only does it let us filter by area to change our area, cities, neighborhoods, counties, school districts, 196, Rosemount, Egan, Apple Valley, zip codes, 55436, right? No problem. That's our Edina zip here. Price range, property type, construction type, size of home, right? We've even got waterfront, riverfront. If you're in Longfellow, you might be riverfront. If you've got 300 feet of, water frontage on Grays Bay or Browns Bay, your private waterfront. So this is by far the most powerful way to look at the market. We talked about choosing your area. Number 2, choose your metric. Pending sales, market times, month supply. Used to have 10 months of supply, now 2, like we saw. Sales price, right? Everybody likes this one. I'll make it a little bigger. And it's pretty clear to see as the Fed started hiking rates, we can see prices leveled out. There was a month or 2 of declines that Jackson and I saw, but for the most part, we really just leveled out. And now it looks like we could have some upward momentum, maybe. Remains to be seen, so let's keep an eye on that. So pick your area, pick your metric, pick your breakout, your filter, your variable, your market segment, however you guys want to think about this. So check it out. Let's split this out. And you know what? If I don't want to look at a line chart, I want to look at a bar chart. Now let's take a peek. New construction, your new builds are 480. Your previously owned listings are more like 350, 355. And that puts everything somewhere in the middle at 370. Let's turn that off. Property type, let's turn that on. And just a little insider tip, guys. If I don't want to look at all, I can either toggle it on and off here, or if I plus it, it adds it back in. If I minus, it takes it off. I'm also going to kill townhomes and condos because that's basically non-single family blended together. There you have it. There's your single family in blue at just over 400. There's your condos in red at about 205. There's your townhomes in green at 3 10. So when we ask the question, here, let me tie this together. When we ask the question, well, why? Not the Sheldon why, but when we start to ask the question, where is it? Where'd it go? Where did you go? I just had it. I think I lost it. Where's townhouse condo market share? Here it is. Idiot. Sorry. Townhouse condo market share, the percentage of all sales that were either townhomes or condos. When people are asking us, why is this metric up 27.1, second highest level in 22 years, 27.1, something's going on. And it's been the last 2 years when rates have been pretty high. Well, I wonder why you see that market growing in popularity. It's because of affordability. It's because of affordability. That's the price point. Now, in some ways, right, condos, look, a little bit of a weaker market, taken over a month to sell versus 2 weeks, a little over 2 weeks and 3 weeks. This one's over 4 weeks. And then look at absorption rates. You'll see higher month supply in condos. 2 single family, 1.9 townhomes, and then 3 for condos. Condos are still a seller's market in most areas, but not as much of a seller's market, not as strong as an area with 1.9 or 2.1 months. One more time, pick your area, pick your metric, pick your variable, and then lastly, pick your settings, right? I'm going to click share. I'm going to share it. Let's click share. You guys will see the URL. I know I'm moving quickly. Let's take a peek at that in a new window. You will notice it's mine. It's alive. It's branded to me. Why? Because it's pulling from my profile over here because I'm logged into InfoSpark. Excuse me, I'm logged into Northstar. So it has branded it to me with my contact info. Guys, this is a marketing piece as much as it is a statistical analysis piece. This positions you guys as the experts in the market who can show whether it's prices, days on market, month supply, doesn't matter. With one click, I click email, one click, I click Facebook. You guys can see it's pulled up the email. It even has the subject line written with a link. All I have to say is my favorite client at wherever, right? Whatever it is. All right, get that out of there. And then, of course, the book face. And what are we calling this? Twitter, X, Muskville, whatever we're calling that one. Anywho, so some really, really powerful ways to share some of that stuff, guys. I do want to call out just a few other things. RPR is a really powerful tool. It really has a lot, so don't overlook that. And then, what was there? One other thing. Oh, I do want to call attention to this, and thanks for spending just one more minute with us, guys. I want to call attention to this because we've gotten questions on it. Happy to field questions. We're delighted to make the reports, but I do want to teach you guys, for those who aren't aware, within showing time, you got to click on reports. Now, you got to scroll all the way to the bottom, which most people don't do. Target market analysis. Click. Showings. People always ask us, where'd you get your showings data? How are you able to do showings data? How are you able to show your showings data? Where do you get showings? Well, here. Where'd it go? Right here. Price range. No minimum. No maximum. Let's see. Let's do the week ending. So 5/16. That would be what? The 10th through the 16th-ish. Use market-wide data. Otherwise, you can go, guys, I can say how many showings were there in Edina. Boom, boom, submit. That's how many during the week, 300 showings. Now, maybe I want to go only up to 500K. Shows you by price point. 5 showings at that 475 mark, 4 between 450 and 475. Here we're starting to see some condos, 14s and 15s. Guys, again, people are surprised. Look, there were 9 showings scheduled on an Edina listing under 25,000. There's a reason it's priced there, and so it's not going to be for everyone, but know that that is a product that exists. So I hope you guys at least got a quick sense for how to do some of this stuff. And it is a powerful way. And if you have a client who's asking, can you do a quick showings report or can you tell me that? You guys can absolutely do that. So that's something else I wanted to show you guys. Let's see. With that, I think we should probably wrap up. A lot more to talk about as always. I'll put up our slide that we usually wrap on. Uh, most agents know what's happening. The good agents kind of understand and get what's happening, but the best agents can kind of explain and convey what's happening. And sometimes we've said, ever since I went to the vet, everything has been loud as heck. Sometimes I feel like we're wearing the cones, the funnels, the cones, and every little bit of noise has been amplified, no matter what it is. Settlement stuff, market stuff, rate stuff, economic recession stuff, whatever it is, it feels like all the noise has been amplified. We are encouraging you guys to cut through the noise, cut through the nonsense, leverage the power of data to help grow your business, more repeat buyers, more referrals, so on and so forth. And with that, I will say, while we don't have time for Q&A, we're grateful that you guys joined us. So thank you. Thank you.
Thank you so much, David. This has not only been showing everybody how to fish, but you showed them how to clean the fish, season the fish, and cook the fish. And now you're all ready for dinner.
I'm hungry now. Walleye.
Um, while
Walleye.
we're waiting for any final questions that people have, I am going to plug our June market webinar. This one is on June 13th, Thursday the 13th, not Friday the 13th, because we never host these on a Friday, but just want to let you know, June 13th. The link is now in our chat here. So if you want to make sure that you don't miss another wonderful market webinar, click that link right now, register while you're on top of it, and you'll be good to go. You'll get those reminders like you do for this one. And I don't see any questions in the chat right now, David. So I think it's time for us to say goodbye, and we'll see you all next time.
Thanks, everybody. Thanks, Jackson.
Take care, everybody.